Just over 30 minutes ago, the Bureau of Labor Statistics released the delayed January CPI report, giving investors a fresh glimpse into the state of inflation. Here's what we learned. Headline CPI came in a tick below economist estimates, showing growth of 2.4% on a year-over-year basis and 0.2% on a month-over-month basis. Core CPI, which excludes the volatile food and energy sectors, increased at 2.5% on an annual basis. That was in line with economists' expectations. Joining me now to break down the data and everything moving markets is Frank Cappelleri, founder and president of CappThesis. Frank, welcome to NYSE Live.
Thanks so much, Ashley. A pleasure to be with you today.
All right, so what are you taking away from today's CPI data?
Well, I think it was kind of the best case scenario the market was looking for, especially after the jobs data a few days ago. And so I think looking forward, the Fed continues to be data dependent, but it still keeps two cuts on the table. And if you think about it from an economic standpoint, this is kind of the best case scenario. You want to see jobs continue. You want to see inflation contained. Now, the thing is, there's other places we can look for inflation data. And what I'm looking at are the charts of commodities, and they're continuing to move higher. So that just brings back memories of 2020 and 21. Remember, we saw crude oil start to move and a lot other as well, where the Fed remained on the transitory, view of inflation. Of course, that changed and they had to play catch up. So that's the concern, is if this inflation continues to move higher from a commodity standpoint and eventually move into the rest of the economy.
All right, and how should investors be pricing in this latest inflation data coupled with the January jobs report that came out this week?
Right, I think we're back to neutral in terms of what we can look forward to. The concern was, of course, a hot number today, which would have pushed cuts way further into the year, maybe if not at all. So I think that's off the table right now. And there's probably concern about that, with yesterday's sell-off as well.
Speaking of yesterday's sell-off, we did see a pullback in the markets yesterday. What do you attribute that to?
Well, of course, it is AI related, and some of those stocks really got hit hard. But if you think about it, other areas get hit hard as well that really aren't related to AI, gold and silver especially. And I look at those two, there are commodities based, but they're more or less momentum trades, from my perspective. So there are a lot of players involved with that, like CTA, big firms are just trend following firms like that, the trading firms, that will get involved in anything as long as moving higher or lower by a good clip. So when there's any sort of little movement like that, sometimes momentum really takes over and you see some big moves to the downside as well.
And the S&P 500 is entering today near the bottom of its 6-week range. What patterns are you seeing and where do you feel we go from here?
That's a great question. And I base my analysis at CappThesis on pattern structure. And so for a long time, we're looking at the S&P is trying to break out through the 6880 zone, get back to above 7,000. And what you can see through the end of the year of last year was a pretty substantial bullish formation in play. We've seen multiple attempts breaking out from that, just hasn't gotten there. So the concern is that buyers just get impatient because we've seen, the market react well on multi-day, multi-week basis, but what we're used to seeing from the previous number of months was buying breakouts, instantly rewarded, and the market goes higher. So if they get impatient, that means that they'll be more apt to sell the next downturn. So there's a kind of an air pocket of light support underneath that down to say 6,600, 6,500, where it was trading in November when we had that 6% pullback. So if we lose this area, I think that's at risk.
We did see the S&P hit or touch 7,000. What do you think? Do you think it's going to be there soon? What are your thoughts?
Well, it's shown the ability to get back up there, but what we need to happen for that zone to actually get busted through, we need large cap tech to participate in a much more aggressive way than we've seen that. If you look at the Mag 7 overall, it's kind of been a rotation within there. We haven't seen all 7 stocks moving up in unison really since October. And if you see that last part of October there, the end of the earnings season, there were some very good reactions. The S&P 500, the XLK, the Mag 7 ETF, all gapped higher, and that was it, right? And so we look at those bigger names, especially the ETFs that hold a lot of them, they haven't been back to the highs now in almost 4 months. The good thing is that we've had enough breadth. The foundation has been very strong. Just seen over 100 stocks in the S&P 500 make new highs 3 separate days in the last 7 days. That's strong. that hadn't happened since November of 2024. So there's a weird dichotomy going on where the biggest names are participating. There's been so much participation underneath the surface that's allowed the S&P to at least stay near 7,000.
And what does today's CPI data mean for the 10-year Treasury yield?
Well, it's ticking lower, and I think that the big line in the sand there is 4.2%. If you go back almost 2 years, it has oscillated around that zone for a long time. So I think, obviously you think that there's going to be a tailwind for equities if the 10-year moves lower. I think that's true if the dollar falls as well, because we've seen over now, going back to at least 2022, and both of them are moving lower, tends to do well for the S&P 500. Growth stocks can outperform as well. But the most important thing, I think, from a 10-year perspective, is that it continues to remain quiet, right? It ticked higher to 4.2% for the first time back in late 2022, 2023. So we've been flat overall since that point. The best thing that the bond market can do from an equity perspective is remain directionless, and we've seen how that's worked over the last 2 years.
In our last minute together, what sectors are you seeing investors right now position themselves toward?
Well, again, there's been rotation. We've seen industrials take off, materials, consumer staples. And so those are almost getting too stretched now to continue at the pace that they are. So I think I'm always looking for budding patterns. And from a long-term perspective, even though energy has done the best, it's still maybe just getting started. If you look at now compared to, say, 2022, or even before that, 2021, energy started to outperform the S&P 500, and the S&P was still able to do well, even though energy was there. There was not until the very end of that run that energy was moving higher and S&P fell. So I think energy stocks, I'm looking for bullish patterns to develop in that. And one other area, again, kind of growth related, but not as much as technology, is communication services. So the XLC ETF still remains in this trading range it's been in for the last number of months. Always look for a compression of volatility like that to precede potential breakout.
Great. Thank you, Frank Cappelleri, founder and president of CappThesis, for joining us at the New York Stock Exchange.
Thanks so much, Ashley.